Good evening. I just wanted to talk to you on a very hot topic that's cropped up today. If you have any of you have access to social media, you'll be aware that there's a lot of guther created and a lot of disquiet in both in distributors and in investors about what a very senior fund manager with one of the largest fund houses said about the small and mid cap segment. And first of all, let me say that he's a very experienced fund manager, been in the industry for many years and has a stellar performance track record. So one should give weight to what he said. I am not going to get into agreeing or disagreeing with you. It is his view and it is his right to express it to everybody. But what I am going to respond to is what a distributor and investor, because I've got lots of calls today from distributors as well as investors who are tending to get worried and tending to panic a bit and wondering what should I do? Should I stop my SIP in small cap? Should I redeem my investments? And what I should do. So I thought I will just give you a perspective of that in terms of the reaction to what he said. Like I said, he has every right to express his opinion, and let's take that at face value as an experienced fund manager giving his view on the market. Now, that coming to that, right? So, what is the situation, right? So, first of all, answer to the question, right? Should I stop my SIP in small cap today? The answer is no. Should I redeem my investment from small cap today? The answer is no. Now, why do I say that? Well, markets go through their ups and downs. Yes, the small cap index has corrected about 10% in the last 6 months since the FIS selling started around the end of September. Mid cap has also corrected significantly, where large caps have corrected less. The point that I'm trying to stress is that as an SIP investor, right, you are supposed to be in it for the long run. Now, there are people who do SIPs as a breaking up of their lump sum over the next 6 months, over 1 year. Those are not the kind of investors I'm talking about. I'm talking about if you have set in a long-term process based on your goals of an SIP and a portion of that SIP is in small cap, you have no reason to panic. Why? Because one of the rules of the market is the law of mean reversion. To put it in very simple, what goes up must come back down to the mean, and what goes down must come back to the mean, right? So yes, this has been 6 months has been a phase where small caps have corrected, and according to the fund manager, there's scope for more correction in it because he says that banks are not taking any risks, and the mutual fund investors and distributors are taking all the risks. So that means, if yours is a longer term perspective, the SIP program itself is one of the foundational pillars of the SIP program is rupee cost averaging, which is buying when your prices are low, more number of units, so that when the prices go up, you have benefited that much more. I think that's a very simple concept. But that apart, I want to focus on this whole concept of investing. So basically, there are 3 fundamental rules that you should look at and apply in reacting to what he said, right? So the first thing is that you should know yourself. You should know your risk appetite, right? In your portfolio, if you have chosen small cap, do you have the risk appetite to take losses when they happen so that you can participate in the gains when they happen? Hanging in through the tough times so that in the good times you benefit. So first, know your own risk appetite. Are you aggressive? Are you moderate? Are you conservative? Second is the question is asset allocation. Never put all your eggs in one basket. I think that you have to choose a range of funds, some large cap, some mid cap, some small cap, and in that context, as an asset allocation, there is, based on your risk appetite, how much small cap is something that a distributor stroke advisor should help you, or even if you are your do-it-yourself investor, you should be able to roughly judge it and accordingly take. Small cap being the highest risk, highest reward segment, and large cap being lesser on that curve, mid cap somewhere in the middle. But the third and most important thing is diversification. When I say diversification, asset allocation itself creates a diversification across large, mid, and small. But what I mean by diversification is within the segment, you choose different styles of fund management, right? So you choose a small cap, you don't put all your eggs in one small cap fund, you choose 2-3 different small cap fund managers, you choose 2-3 different large cap fund managers. So by diversifying across different styles, right, you will gain a bit. And let me explain to you why I'm saying this, right? These 3 combinations, right, that is assessing your risk profile, asset allocation across almost all the asset classes in the market, and third, diversification even within specific assets. These 3 are meant to give you a better reward to risk ratio. The industry has a lot of jargon, Sharpe ratio, information ratio, and all that. But basically, it is the reward per unit of risk. What is the risk you take? The risk is the variability in the returns, or the highs and the lows, right? Now, just to make this point, I want to make this point. Now, obviously, everybody is feeling, oh, small caps have corrected a lot, small cap. But when you diversify across fund managers, and I just came across some recent data, right? So you take from a 52-week high, the fall, right? Everything has fallen. Large caps have fallen, mid caps have fallen, small caps have fallen, and so the funds have also fallen. But I was just looking at the data, and let's just compare the two extremes, right? Let's compare the large caps with the small caps, right? So the best performing large cap fund managers, I've taken the 3 or 4 average, and the worst performing large cap. Similarly, the best performing small cap and the worst performing small cap. You'll be amazed and surprised to know the results, right? So the worst performing large cap managers, 3 or 4 worst, lost 13% from their 15-week high. How did the worst performing small cap fund managers do? They lost 15%. So the difference between a so-called very safer large cap category versus the high risk small cap category was a 2% 1 year from the 52-week high to the low, the drop. This is the worst performers, right? I have taken 3 or 4 and taken the average of that. Okay, it's not just one particular fund. But let's take the best performers. Everybody's fell. The average of the best performing large cap fund was down 9%. And surprise, surprise, the average of the best performing small cap fund was also down just 9%. So both the large cap and the mid cap have lost the same amount of the money from their 52-week high, and the difference in terms of the worst is 2. Why is this the case? Because there's a lot of flexibility within a fund manager to choose across sectors and to choose across cap curves. For example, a small cap fund, SEBI's rule only says that it should be 65% in small cap. So fund managers have the flexibility to put their balance 35 either in mid caps or in large caps. And different people use that flexibility differently depending on their approach, right? So that's one. Similarly, across sectors, you'll see the variation in the sectoral performance over the last 1 year is tremendous. The worst performing sector is minus 20%. The best performing sector is up a few percentage points. So a smart allocation by the fund manager across sectors has helped to either do better performance. So the point is that a good performing small cap fund in this could have beaten the worst performing large cap fund. So diversification across fund managers and fund houses is also key, right? So if you do that, then you will realize that jumping from one to another, there is a saying in English, right? You can't run with the hounds, right? And run with the rabbits. The hounds, that is dogs, are meant to chase the rabbit. So either you can be chasing there, and then at the right time you should switch from large cap to mid cap, small cap. It's impractical. Nobody ever got that right. That's why they say time in the market is better than timing the market. So simple thing is just these 3 rules. Let me reiterate that once again, right? Know your risk profile. Second, allocate across various asset classes according to your risk profile. Third, within asset classes, diversify across fund managers. With all of this, right, I'm saying that your long-term SIPs should be in all of these, and the proportions based on your risk profile. And if you are a 10 plus 20 year return, your weighted average return across this will more than comfortably beat inflation and help you meet your wealth creation goals, whether they be for a future wedding or for a family holiday or for your retirement, right? So with that in mind, I just want to leave one message. Do not panic with all the noise that's happening in the social media today on this thing which got public, right? Stick to your goals, use an advisor if you feel the benefit of the advice, which is definitely invaluable, and repeat once again the 3. Know your risk profile, asset allocate, diversify. So with these 3 words, I'd like to conclude this video. Thank you. All the best. Happy investing.